This is the current federal tax developments for the week of October the 8th, 2018. Current federal tax developments are brought to you by Kaplan Professional Education and by your state society of CPAs. I'm Ed Zollers, and we're going to be doing a few things this week to look at what's happened in a week that actually gave us something we've been waiting for quite a while from the IRS. The topics this week, well, we're going to get the Sifl rates for those of you who are looking at this for aircraft, and that wasn't really probably what we were looking for. Also, another information letter that tells us a bit about how the state and local tax workaround regulations work or don't work in areas. The one we're waiting on is the IRS finally gave us some guidance on how we deal with business meals following the Tax Cuts and Jobs Act repeal of the ability to deduct entertainment expenses under 274A, and that's generally good news this week. The IRS updated the EPCRS program for qualified plans to fix problems in those plans. The IRS also ruled that market discount will not have to be conformed to. In essence, the market discount rules will not be impacted by 451B's revenue conformity provisions that were added by the Tax Cuts and Jobs Act. And finally, another information letter on a 457 plan that makes clear to us that when Congress does things as they did in the area of hurricane relief, where they allow plans to optionally offer distributions to individuals, they are optional. That what they offered there was an optional benefit. That's important because having just gotten through Hurricane Florence, it's not clear it will happen again that Congress will pass a similar bill, but it would seem not terribly unlikely that we might see something like that in the lame duck session. And again, reminder, you have to be careful with benefits for things like qualified plans. They don't apply necessarily to everybody unless the law requires it. And in this case, the law did not require that those benefits be provided to everyone. As such, they weren't provided to everyone. And we'll talk a little bit about how that worked out this week in the case. But let's start with the simple thing this week, which is the IRS put up the Sifl rules. And what ends up happening with the Sifl rules is that under the SIFL, those are the rules, and were found here in Revenue Ruling 2018-26. And Sifl deals with situations where a taxpayer is providing aircraft for use by employees, and we need to get a personal portion of that aircraft usage. And we have these tables that are used. Now, we know this was changed a few years back to eliminate what used to be a benefit that you could get off of this by using the SIFL rates for what went into W-2s, but deducting a much higher expense on the corporate tax return. We now have limits on that, but nevertheless, it's still important for non-control employees that these rules are in play, and even for control employees, we just lose deductions. At this point, we got on October 1st were the rates for the last half of 2018. These rates tell us how we calculate this, and these rates apply from July 1st to December 31st of 18. The terminal charge, which is the base charge on any of these trips, is $42.88. On top of that, you have a mileage charge, and the mileage charge has been updated, and it depends upon how far the trip is. If it's less than 500 miles, we have 23.46 cents per mile. If it's between more than 500 but up to 1,500 miles, it's 17.88 cents per mile. And above 1,500 miles, we're looking at 17.19 cents per mile. Now, as I said, these are in effect going back to July 1st through the end of December. On January 1st of 2019, we will again change these rates, and of course, you'll be watching for them. But if you were looking for the SIFL rates, they are now out. Next up, the IRS gave us a clarification to the clarification. This is Information Letter 2018-003 that was issued on September the 28th of 2018. And this deals with those proposed regulations that we got for state and local tax workarounds. Remember, we go back now, we've been through two developments here. So the key thing to remember is when we look at these state and local tax workarounds, what we had here was back on August 23rd, we had proposed regulations issued that said, if you make a contribution to a charity, you claim a chair, and you have a chair, and you're going to want to claim a charitable contribution for that, but the state gives you a reduction in your state income taxes in excess of 15% for having made that contribution. Under the proposed regulations, you're going to have to reduce that contribution dollar for dollar on Schedule A. This is important because, as we know, charitable contributions are not capped for purposes of the deductions on Schedule A, but state and local taxes have a $10,000 cap. Some states had passed special credit programs to work around this. Other states had pre-existing credit programs that could be used to work around it. And the IRS issued proposed regs that basically said, all of that, tough luck. We're going to basically say, nope, you're not going to be able to get money ahead by making the charitable contribution. However, shortly after that, we ended up with a set of rules that came down where we got on September 5th, we had issued by both the IRS and the Department of Treasury clarifications to those regs that told us if that contribution could be justified as a trade or business expense. Well, the law didn't apply to that because the law did not apply to 162A deductions. So conceptually, the idea was if you could and main case law for this goes back to the 1970s. In the 1970s, we had a lot more C corporations for closely held entities. In fact, we had those all the way through the 1986 Tax Act. And so these cases that developed through the 1986 Act on C Corps were important because C corporations can only deduct 10% of their taxable income as charitable contributions. They're capped at 10%, not 50 or now 60% like individuals. So it was a problem to make charitable contributions to a closely held corporation where the corporation was probably not going to show tons of income. Like it or not, back in those days, we did do a lot of bonusing that took a lot of income out of those corporations. So the cases arose where people said, no, we didn't make a charitable contribution to this, to this orphans fund. We rather put money into this fund for business promotion, to promote our business and say, we're a primary backer of, the St. Regis, orphans program. And because of that, you should buy our products. And there are cases that went, whether that was okay or not, situations. What we have now is if you can justify that, then the implication, though not actually stated here, is that you would not have to offset. In essence, they say the regs don't apply. They don't tell us if there would be any, justification for the IRS to require an offset there as well. Well, a few days after that, at least one person was moved to write the IRS and say, well, wait a minute. No, now we have a different program here. We do these following things. And, for doing things like, let's say, like you might have a program in the state where if you hired somebody who had been long-term unemployed and the state would, let's say, give you a credit equal to 50% of the first 6 months' wages up to some cap. Is that impacted by this? It's more than 15% of what we're paying. Do we have to do a reduction? This particular information letter makes clear that no, all the proposed regulations are going to affect our contributions and tax credits for contributions, and they have no impact and do not change the law for anything outside of that. Now, that's interesting because, of course, they don't really tell us what that law is. And as I say, the implication has been, and certainly the implication which Treasury Secretary Mnuchin in his statement on the Treasury statement was, gave a strong implication that you don't need to reduce that deduction. But we've never actually had that directly said. So for what it's worth, we do have now another clarification to the clarification. So if you were worried because you weren't giving to a charitable program, but you were doing something that a state or locality gave you a credit for that was also a deductible trade or business expense, well, the IRS now says, don't worry about those proposed regs. Next up, now we got the big thing for this week. This is notice 2018-76. This came down on October 3rd. This is the guidance for business meals. As you probably recall, the Tax Cuts and Jobs Act took and changed Section 274 and now states under 274A that any amounts paid for entertainment are not considered deductible for federal tax purposes. That is troublesome because, and there's a really good article back from February. I think it was published in Tax Notes, the print version, a bit earlier. Tax Notes today, it finally showed up, I think, in February, by Gary McBride, that traced the history of 274 and made it clear that from the beginning of 274 all the way through the 1986 Tax Act, Congress had considered meals to be, when you take a client out for lunch, that is a form of entertainment. And he said, if you followed that history, and even if you read some of the regulations, they seem to imply this too, that Congress had essentially wiped out the casual business meal. As Gary points out, old 274, when it first came in the law, had a section 274E1. We still have an E1 now, but it covers something different. That specifically exempted from the limits on entertainment on the original 274 passed in the 60s any casual business meals. And that was removed in the 80s when Congress wanted us to start applying the same test for entertainment, what's qualified entertainment, to qualified meals. Now those tests got pulled, but so did any reference. We didn't add back the casual meal exception. So we have spent the past few months not knowing. The committee reports told us that Congress did not intend to change the taxation of meals otherwise legitimately deductible. But all they told us for sure in their examples were meals for employees on, who are traveling. Those probably weren't entertainment. Well, I mean, okay, if you read the regs, they might have been, but they probably didn't qualify. We were much more concerned about that meal where we take a client or a potential client out to lunch. Is that deductible? Well, good news. The IRS now says if you meet a 5-factor test, then you'll be considered to be able to claim the deduction. The first test is a simple one. The expense must be an ordinary and necessary expense paid or incurred during the taxable year incurring on a trade or business. We've got it tested under 162A. Every expense, pretty much. There are a few exceptions, but for the most part, all of our expenses go through there anyway. So that's not really a big hurdle. If you can't clear that hurdle, you have other problems. Number 2, this is part of 274 that's still there. The meal cannot be lavish or extravagant. Section 274K, as I recall, has a limitation that says you cannot deduct a lavish or extravagant meal. So that's there. Now, it didn't tell us we could deduct them if they weren't. They just told us what we couldn't. Congress didn't touch that section. So it cannot be lavish or extravagant. Now, that has never been a really big bar. I guess maybe if you decided that lunch was going to be, taking the client for a private lunch in Dubai, then maybe that's lavish or extravagant. Private lunch in Dubai, and you're going to be, having caviar that is at the super high end of the market. Okay, maybe. But your average dinner meal, even at a nice restaurant in most cities, is going to be fine. I don't think we're going to have any trouble there. The taxpayer, an employee of the taxpayer, has to be present at the furnishing of the food or beverage. So essentially, one of you needs to be there. That's also normally not a problem. It means if you actually just give food to a client, you basically are, shall we say, giving them restaurant stuff. That's not covered by this. Also, essentially, you have to provide that meal entertainment to a current or potential customer, a client, a consultant, or a similar business contact. That's test number 4. And then test number 5 is the baseball game rule. We saw this. If you read the Wall Street Journal article, there was an example of a hot dog at the baseball game. If you have a situation where food is consumed during entertainment, if the food is separately stated from the entertainment cost, then you can claim the 50% deduction for the food. Now, they tell you right away, don't get cute and tell me suddenly that, that's skybox you have for going to, let's say, an NBA basketball game, that the entire cost of that's for food. No, they say we're going to look for those workarounds and we're going to try to shut them down. Key thing to remember, these 5 factors only apply to meals that are not otherwise kicked out of the exclusion by 274E's list. 274E has a whole list of various types of entertainment items or meals items that are not subject to these limitations. That includes meals provided for employees, by the business or provided, on site. Now that one's got a little problem with the employer provided eating facility issue that Congress put in, and the IRS is kind of reserved on guidance on that. But there are a bunch of others there too, like, the standard holiday party is also generally covered, and that food's okay. So make sure you go to 274E. This 5-factor test only applies if you don't meet any of the exceptions under 274E. If you meet any of those, don't worry about these 5 factors. If you don't meet those, then we go and check against these 5 factors. The IRS notes that these will be provided in new regulations under 274. They're also asking whether the old regulations should be changed. I think they probably not only should be, but probably have to be to come in compliance with this. So I think we're going to see some heavy rewriting of Reg 1.274-1 that's going to have to be revised to make this work. But the answer we have now is we do know what business meals are. Now, a couple of things to note. First thing is, hopefully your clients have kept all the documentation on these business meals, because we still have the same problem. We're going to have to document this stuff to take the deduction. Number two, that separately stated meal may be a problem for some people, especially for, let's say, if you do have that skybox and sporting event and there was food provided as part of the arrangement. I do think we're going to see that changed here now, so that food will be separately stated, not bundled into the fee. So we'll have a separately stated food item so that we'll be able to take those deductions. We'll no longer be combining it. But that could create a problem. You might not have that because we didn't know that that 5th requirement was there. By the way, interesting things you won't see here is any requirement that we have at the business discussion. That may arguably be somewhat implied with ordinary and necessary, but not, it's part of the deal. Part of the reason why that's not there is the provision actually mentioned that, and which applied to some meals, was repealed. It was in the code. It's not there anymore. And I really do think the IRS does not believe they could add it back if Congress specifically took it out. I'm pretty sure Congress didn't know that, they didn't know they were affecting meals when they took those sections out. So I'm not sure it really matters. But nevertheless, it's there. So in any event, the good news is the IRS is not, in this case, unlike the case of the retail glitch, stating that, well, this is just something that the IRS got wrong. And basically, we just, I should say Congress got wrong. And it's going to effectively take a technical correction for this to be fixed. The good news is we don't need the technical correction. Next up, for those of you that deal with qualified retirement plans, in Revenue Procedure 2018-52, issued on September the 28th, the IRS updated the Employee Plans Compliance Resolution System, or EPCRS, get that right, program. Now, EPCRS really covers 3 different, right? It impacts qualified retirement plan generally. When there is a flaw in the plan, or there's been a problem or an operational issue in the plan, this is how you can fix it without having the entire book thrown at you. There are ways you can do it. And actually, EPCRS is really 3 separate programs, right? The first program is it impacts the self-correction program, also known as SCP. Some issues with plans, you don't have to get IRS permission. This revenue procedure tells you how to fix things. Like if you somehow failed to fund things you should have, they tell you how to fix that and how you can fix it on your own. Now, all of these things do require that you establish procedures to stop this from happening in the future. So you can't keep going to the well too many times here. But if you've discovered a problem with the plan, you take a look at whether it can be fixed under the self-correction program, or SCP. There are some things that are more serious that the service believes they need to be told about, and for which there needs to be some sort of fine levied, but it's much less than the full thing that the IRS could throw at you. And that's the voluntary correction program with IRS approval, VCP. The big changes in this revenue procedure are to VCP. They now require you to use pay.gov to pay the fee for it. They also have some changes procedurally to the program. The major changes, as they note in the description to this, are in the VCP program. Finally, the third option is, you didn't catch this, but they did on exam. That is called audit cap. Audit cap is what you can voluntarily enter during an audit and correct problems that the agent discovered. Now, the catch is, as you may expect, audit cap is not nearly as nice to you as VCP. The IRS wants you to correct things via VCP, or SCP. They do not want you to say, well, we'll wait till they find it and do it via audit cap. Basically, they want you to take a look at that. Now, of course, as I said, the main changes here to VCP, these programs are important. And by the way, they're important for you if you have a qualified plan you're sponsoring. And obviously, if you're in the business of doing examinations of qualified plans or otherwise working with qualified plans as a CPA firm, you do need to be aware of this program and be aware of, recommending clients go through this program. What's available, what can they do, how do they fix it if you discover a problem, an operational issue when they're running the plan. Understand these programs, it's really important. And so the key issue is these programs have been around for quite a while. This is just an update to the program. And as I said, the major update really was they want you to pay online. That was the big thing that came out of all of this. So, hey, we discovered a little something, pay online. Next up, we have in Notice 2018-80 issued on September the 27th. The IRS tells us about the impact here of what's going to be market discount. If you have market discount on bonds, 1291A governs the reporting of that revenue. Okay, that's a section. Now, there was concern because, as we know, the Tax Cuts and Jobs Act added Section 451B. 451B says if you have an Apple financial statement, you have to recognize revenue at least as quickly as you do on the financial statement if you are using the all events test. This caused concern among some people where, for GAAP purposes, this market discount was being realized faster than 1291A required it to be recognized. They were concerned that 451B the IRS might argue that 451B would force them to recognize that revenue quicker. My gut had always been that would not be the case because 451B pretty clearly indicates it covers the all events test. It doesn't cover the other things. But again, people were concerned. So the IRS now has issued a notice that says this method of accounting will not be found to require conformity when they issue the regulations under 451B. We still do not have guidance or regulations under 451B, and we're still awaiting that. That conformity rule, if you've not looked at it and you have any clients, okay, basically your Apple financial statements would be those issued to the SEC. If you have those, you have an Apple financial statement. So if you're in a public company, you have an AFS. Also would be any audited financial statements. This is the one where I think a lot of local CPA firms have got to take a look at. If you are a firm that does audits, every client you're auditing will have an AFS. You need to check to see what GAAP's doing. Remember, we are now changing over under 606. We're going to be changing how we recognize revenue. For some businesses, that will cause GAAP revenue to be recognized faster than it's been in the past. That could cause issues. Again, the tax people and the accounting people need to talk about this 451B issue. Do we have that problem? And also remember, it does talk about those who are using the all events test. Certain things like, in my position, long-term contracts, completed contracts are not the all events test rules. They should not be impacted by 451B. In essence, we should be able to still have GAAP 451B, or we should have GAAP 606 variant on what we've been doing for construction contractors, as compared to 451B for those people who are doing the tax basis completed contract, or I should say tax basis long-term contract percentage of completion. Now, I should add, there is an issue. There are cases where GAAP allows or requires percentage of completion where tax doesn't treat that as long-term contract. Those are very concerning. So we're going to keep a close eye on that for 451B. But that's a kind of a different problem there. And again, it's one of those odd issues. Finally, we have another information letter issued by the IRS. This is Information Letter 2018-0024, issued on September the 28th of 2018. Last year, as part of the Disaster Tax Relief and Airport and Airway Extension Act of 2017, Congress added various provisions that allowed qualified retirement plans to make loans or distributions to individuals impacted by the 2017 hurricanes. This particular letter came from somebody who had damage. They were trying to get money for repairs from a 457 plan they participated in for damage caused by Hurricane Irma. And of course, the plan was apparently telling them they couldn't get the distribution. And of course, they were concerned because they had said, wait, Congress passed this rule, we can get this money. The IRS had to tell them, sorry. Under that rule, plans are not required to offer such distributions. They are what it says. You read the law; it's very clear. A plan is allowed to establish a program that would allow for such distributions. Now, if they do so, they have to get that plan amended eventually to do that, and they've got to start acting as if the plan was amended already. There are steps plans have to take to be able to use those special rules. In this case, it appears at least this 457 plan is not taking those steps. And because they're not taking those steps, you're not going to qualify for the distribution. This particular case and this law of 2017 only affects 2017 hurricanes. However, as I mentioned earlier, this is the kind of thing that would not be surprised to get into a year-end bill this year to give relief to Hurricane Florence victims in a similar fashion. And the thing to recall is, if that happens, those of you in the Carolinas, affected areas, remember, the plans have to make a decision if they'd offer this. And if they do, we've still got to get our plans updated to do this. But plans are not required to do this. Now, again, we don't know if Congress will do this because this is the sort of thing they throw into a year-end bill. We're going to assume we have a year-end bill. A lot of people think we will. In fact, there's been a lot of discussion of there are some extenders necessary. And certainly, the chief Democrat on the Senate Finance Committee, Mr. Wyden, has said he's open to discussion. He hasn't said what he wants exactly, but he's indicated that the retirement bill that he and Chairman Hatch had agreed upon in the Senate Finance Committee is something that he'd really like. So we're probably going to see a year-end bill. And the retirement programs that are in the Senate Finance Committee bill, those have a pretty good chance, I think. I mean, the House passed a similar provision as part of Tax Reform 2.0. Now, that was a show vote that we're really not going to do anything with for the election. But they could very well use. They did split out the retirement fund separately. That particular bill could come over to the Senate, and don't be surprised if that then becomes our vehicle in the lame duck session for doing extenders and for any other things, which could include things like this hurricane relief. I'm certain that the senators and representatives from the Carolinas will be pushing for a similar program to be adopted this year. So keep your eyes open for it. But again, remember, plans have to change. If they allow that, plans would have to be changed to allow any such relief. As I say, we're here, and I know a lot of you guys, and I, in fact, as soon as I finish recording this, I'm going back to finishing up a bunch of returns, are probably knee-deep in returns, not thinking a whole lot about this right now. But remember, we're coming up on CPE season. Be sure to go check your state society CPE courses. There's tons of things coming out here every week on the Tax Cuts and Jobs Act. There's lots of updates. Lots of things have happened, over the past few months. This year, for certain, take a look, find yourself some continuing education that's going to directly help you with understanding what's going on, because all of this stuff will impact the returns you're going to prepare for 2018 and all the tax planning you're going to be doing with clients for the 2018 year here at the end of the year. So check your state society courses. Check for our Kaplan courses that are offered by many of the state societies. Also, and any of the others that make sense. But obviously, I would love to see any of you who are going to be at courses I'll be teaching. Again, I remind you, I'm going to be teaching specifically the Tax Cuts and Jobs Act business issues, both in Idaho at the end of October, and I'm going to be teaching it in Arizona. And both of those courses will be webcast. So we're going to have that. And I believe now we've got confirmed that we should be able to offer EA credit for the course in Idaho. So if you're going to be interested there, then we should have some EA options there too. We'll take a look, see how that goes. This has been Current Federal Tax Developments for this week of October the 8th. Be sure to catch our regular updates online at currentfederaltaxdevelopments.com. You can follow us, send questions and comments to me You can send them to edzollers@currentfederaltaxdevelopments.com. You can also follow me on the subreddit at reddit.com/r/taxpros. I also will take a look in to some online discussion groups. Specifically, I'm regularly posting to the groups for Arizona, New Jersey. I'm also posting on Cal's Tax Talk group. So you have any of those groups or those state societies, take a look, see what we're going on in those areas, and just keep up. This is a year where lots happening. So it's really important to keep up. And I'm not going to promise that next week I'm going to get this out on time. We're racing to October 15th, and I have a few things I need to also get done. I'm going to be taping a session for later rebroadcast, for later broadcasts. It's going to be used for continuing education. I'll be taping that also right after that, and then going and doing a bunch of in-firm sessions right at the end of October. So I can't guarantee when the next one will come out. Certainly in 2 weeks it'll come out, if not next week. But don't be shocked if next week's doesn't show up. Just warning you ahead of time. We'll try, but it might not happen. In any event, though, keep watching here. Keep on the website. We've already posted some updates already this week on additional things going on at the American Bar Association conference and some guidance we got there. So be sure to check on the website and be sure to check back in for the next broadcast here for current federal tax developments.